So, see, today we'll be starting with financial management, right? Now, the question arises that whenever we are talking about financial management, what exactly is the meaning? See, whenever I'm talking about financial management, that means I'm talking about optimum procurement as well as optimum usage of finance. Now, the question arises that why this finance is so important. See, we say that finance is the lifeblood of any business because I might have business related to item X or Y or Z. But the thing is, to run any sort of business, any type of business, I need finance. That means I need funds. And for those funds, I need the optimum procurement. That means I need the resource, or I need the source rather, from where I can arrange these funds. And when I arrange these funds, I cannot let them go waste, because if my finance is wasted, then this finance is not free of cost. There is a cost attached to every finance that you arrange in your business. Or I can say there is a cost attached to every person who is giving you finance. If I am running a business, if I am starting a business and I am providing my funds, so it means even I need something in return, right? And I am not going to provide you funds free of cost. So similarly, whether it is a bank who's providing you a loan, or people who's providing their money, or you are getting that money from any source, there is a cost attached to it. If I'm giving you my money in the form of, say, for example, equity, when I use the term equity, that means I'm talking about owner's funds. The owner is investing money in the business. So in that case, I need something in return. No matter being owner's funds, that means I have to bear the risk also. So as an owner, I have to bear the risk of loss as well as profit, right? But if I am a bank, that means I am a financial institution. And as an institution, if I'm providing you funds, so that means I am not bothered whether you are earning profits or not, but I need my money back on time. So in that case, what you have to do is you will have to give me my return in the form of interest. So when you know that there is a cost attached to every single penny provided to you in the business, so you have to see that how you can use that money or those funds in an optimum manner, right? So for this optimum procurement and optimum utilization, we have different sources of finance. I can get my own funds. I can get it from my friend circle. I can get it from a bank. I can get it from a financial institution apart from bank. If I'm talking about a company, I can get it in form of shares. I can get it in form of debentures, and there are many other ways, right? So I need to list down all the available sources of finance, and then I need to make a comparison. When I'm saying I need to make a comparison, that means I need to compare the risk involved in each one of them. Because when I use the term risk, that means there is a cost attached. So I need to compare the cost. I need to compare what are the pros and cons of getting the funds through this source, right? So whenever you are arranging or you are procuring funds this way, that needs to be invested. It's not just that whatever money you are giving, I'll keep it with me and my business will run. No, that money is to be invested. And when I have to invest it, then I have to again make a comparison that what all returns will I earn, what all returns will I get because of these investments, right? And I should also see to it that my return is more as compared to my cost. Say, for example, if I have to pay you a cost of 10%, that means I need to earn something more than that. Then only I'll be able to pay you and I'll be able to earn something for myself. But if in case I am not able to earn more than what you have to be returned back. That means if I'm not able to earn something extra apart from the expense, because whatever you will be earning, that will be an expense for me, right? So if I'm not able to earn, that means like in the question, I took the example of 10%. If I'm not able to earn that 10%, first of all, I will not be able to pay you back. Point number one. Secondly, I will not be able to earn something for myself. And whenever you are into a business, so you need to see that you are there to earn profits and not for charity, right? So if I take the example that you start your own hospital, so even see, no doubt when I talk about hospitals, we say that it is not a profit organization. But if I talk about the present day situation, even the hospitals, they are try to mint money, right? So as a result, you will have to see that you have that much of return from the finances that you have arranged. So your overall return should be more than what you have to pay to your finance providers, right? So as a result, whenever I'm talking about financial management, we consider this as a function, right? Now, the question arises that when I'm talking about financial management, that means we consider that as the management of finance function, or you can say that it is a function based on which you will be able to manage your finances, right? So ultimately, when I'm talking about financial management, my basic objective is to reduce the cost of funds. That means whatever funds I have procured, I want to reduce the overall cost, because I'm saying optimum procurement and optimum utilization. When I use the word optimum, it means minimum cost with maximum output, or in this case, you can say minimum cost and maximum return, right? So in this case, we try to reduce the cost of funds that we have procured, keeping the risk level under control, so that we can achieve the effective deployment of funds. When I use the term effective deployment of funds, that means we need to invest these funds in some of the other projects, right? So that investment should be effective. Effective in the sense we are able to utilize the funds in an optimum manner, right? And also when we talk about financial management, we want to know, or we want to ensure that the availability of funds is sufficient enough. That means we should not face any shortage of funds. As and when they are required, we should have the required funds, and also there should not be any idle funds that are lying without being utilized. Because if you are having idle funds, see, no doubt there should be a particular level of finance funds available in your office or in your organization, so that you can run the day-to-day expenses. But say for example that your daily requirement is 10,000 rupees a month, sorry, 10,000 rupees on a day for the day-to-day expenses, but you are keeping 10 lakhs of money idle. So if you're keeping that 10 lakhs of money, so that will ultimately reduce your overall productivity. As I told you, that whatever funds you are arranging, that is not free of cost. So if you're just keeping with you, fine, you can keep it with you. But the thing is that at the end of the time period, you have to pay an amount on that in the form of interest, or maybe in the form of dividend, or maybe in some or the other form. So if you are not ready to employ these funds, if you are not exploring the options where you can invest this money, so ultimately it will increase your cost. Now let's talk about the actual definitions of financial management. Financial management is concerned with management of flow of funds, because whenever we are talking about funds, the funds, they keep on flowing. That means they come, stay in the organization, they move out. So there is a continuous flow. And this, whenever I'm talking about these funds, they keep on changing their form. Sometimes I buy raw material from those funds. So now they have changed into raw material. Then I put them into the production process. That means done the production process. So they are in between the what we call it as work in progress. Then they get converted into finished goods, right? Then I sell them, and when I sell them, many a times they are on credit. Like in the hospital industry, what do? You provide the services to your patients, and when you provide, no doubt, like when a patient is admitted, certainly you get the payment maybe within next 2 days or like that. But still, for those 2 days you need that much amount, and there is not just one patient, so you need to move on with the cycle. So as a result, we need to manage that flow of funds and involve decisions, and those decisions are related to procurement of funds, investment of funds, and distribution of earnings to the owners. Because when the owner is involved in the business, that person is not only for charity. That person is not only to provide services. I'm not saying that people do not provide services. Certainly they provide. But yes, they also need a part of it for their own livelihood, right? So as a result, they need some earnings for themselves. So ultimately, we can say this financial management is related to the planning, organizing, directing, and controlling the financial activities of the organization. Now, if you just have a look, if I talk about these four words: planning, organizing, directing, and controlling, these are the functions of management, right? Whether I'm talking about financial management, whether I'm talking about any other management, these are the functions of management, and every function requires these functions of management. Like in this case, we are talking about financial or the finance part of your organization. So when we are talking about this finance part is also to be managed in the similar manner. That means I need to have planning, I need to do planning. Then once I plan, then I need to organize the required things based on that planning. Once I have organized all the resources, then I need to direct. I need to tell people what is to be done, right? And need to see that things are being done in the exactly the same manner in which it is required. And lastly, controlling is there. When I use the term controlling, that means I'm talking about that your actual working should match with the planned, so that whenever there is any deviation, whenever move left or right as compared to your target, so that will bring you back to the target line, right? So that your financial activities of the organization are exactly on the right track, right? Now, when I'm talking about this financial management, see, this financial management is a, you can say, wholesale discipline. But this discipline has undergone a change over the years with respect to its scope and its coverage. So when I'm talking about financial management, similarly, the role of financial manager has also undergone a major change over the years, right? And the study of these changes that have taken place over the years is known as scope of financial management, or what we call as the nature of financial management, right? So as a result, we have divided this overall topic, or you can say overall nature, into two categories. That is, one is the traditional approach and the other one is the modern approach, right? We'll be studying both of them, what the traditional approach was all about, what the modern approach is all about. But traditional approach is not into picture now. If I'm talking about the modern organizations, I'm not saying that any organization is not following this. There might be people who still want to continue with the traditional approach, depending upon what kind of structure you have in your organization, or maybe what is the level of your business. But still, if I talk about the full-fledged change, and if I talk about the modern organizations, they follow the modern approach. If I talk about the traditional approach, this traditional approach was popular in the early stages, where the role of financial management was restricted, or you can say it was limited, and it was limited to the extent of raising and administering of funds. That means you need to raise the funds, and you just need to administer that, what all is happening with those funds. And when I'm talking about administering the funds, that means I'm talking about the funds which are needed by the enterprise by the organization to meet its financial needs. So as a result, they were dealing with arrangement of funds, and that arrangement could be from different sources, say for example from the financial institutions, because previously, if I talk about the early stages, even the sources of finance were limited. We never had so many different options, right? Secondly, whatever funds you want to arrange. One option could be in the form of financial institutions, like you have banks and you have other non-banking financial companies and all, who can provide you with different types of funds. And the second one is you can get those funds, or you can arrange the funds from the various financial instruments. When I use the word instruments, that means I'm talking about shares, debentures, bonds, and under shares also equity shares, preference shares, and all, right? Because every organization has different kinds of instruments which they can issue to the general public and get their funds. So depending upon that, what do they want? They want to dilute their stake. They want to, dilute their stake, or you can say they are ready to share their ownership with others. So they can issue equity shares. If they are not ready to share their ownership, then they can come up with preference shares. Or if they want, just like you can say loan, so they can deal in debentures, bonds, etc., right? But at the same time, they also need to look after the legal and accounting relationship between the organization and its sources of funds. As I told you, if you are like I gave you the example, that if in case you are ready to share your ownership, so that will bring a change in the you can say relationship. How? Because if I'm saying that, okay, I want to issue equity shares, so that means I'll have to share my ownership with you, because equity shareholders, they are considered as the true owners of the organization, right? Secondly, if I say that, okay, I'm not ready to issue the equity shares because I do not want to share my ownership, but I also do not want to go for debentures. That means, see, here we have two components. One is known as equity, the other one is known as debt. We spell it as DEBT, that is debt, but when we pronounce it, it is known as debt, right? So if I'm not ready to share my ownership, then I either have the option of preference shares or debt. But if you think that you even the market is such that it is not appropriate to issue debt, it is much more appropriate to come up with shares. So in that case, you can go for preference shares, right? But if you think you just want it in the in the form of a loan, then you can go for debentures and bonds, right? So accordingly, your relationship with the finance providers will be decided, right? So as a result, we can see that the role of financial manager here in this traditional approach is limited. So that means he just need to keep a record of all the financial transactions. He need to prepare the reports of the financial status of the organization and its performance, and he or she needs to manage the cash, and that cash is to be managed in such a way that the organization is in a position to pay its debts, its obligations, its payments on time, right? So as a result, this financial management was known by the name of corporation finance previously. Because what does it mean? That you are just managing the finance of the corporate. Corporate means we are talking about the organization in consideration. But if I talk about modern approach is more vast. It has a broad concept, right? And in this case, your financial management, it will provide you with an analytical framework for financial decision making. That means it will not only cover what was covered under the traditional approach. Certainly what was there in the traditional approach will be taken care of in the modern approach also. But apart from that, you have to take care of certain other things also. That means they say that you have to study, you have to consider the acquisition of funds as well as the allocation of funds. That means from what all sources you are arranging the funds, and on which all projects or on which all you can say options you will allocate the funds and on what basis, right? So as a result, we say that this term, or you can say this approach, is more broad, right? So in this case, what we have seen is the main concept or the main contents of your modern approach is that what is the total volume of funds which are required by the organization, the total requirement I'm talking about. Secondly, if I am if I have calculated my total requirement, then what all specific assets the enterprise requires, right? Because until and unless you know your assets, you will not be able to judge that, okay, this much is the total requirement. Then how should these funds be financed? That means I'm talking about the sources, right? So this overall financial management in the modern approach can be divided into four major financial management decisions. So that means our total financial management revolves around these four decisions. And these four decisions are the investment decision, financing decision, dividend policy decision, and the funds requirement decision, right? No doubt we'll be doing all these decisions one by one in detail. Right now, when I'm talking about financial management, this financial management has different functions associated with it. The first one is estimation of capital requirements. As I told you, that in the modern approach, until and unless you know that what is the total requirement of the funds, you will not be able to move ahead, right? Because if I do not know how much funds are required, then how will I arrange the required amount? And if I do not go for a proper planning in this case, I'll give you a small example. Say, for example, my requirement is of 6 lakh rupees, right? And I do not do that much planning. And I say, okay, let me just get 10 lakhs arranged. And I borrow 10 lakh of rupees. Though my requirement is 6 lakhs, I have borrowed 10 lakhs. And the problem with that 10 lakh would be that I need to pay the cost of 10 lakhs of rupees. No matter I am having that money with me, but that extra additional 4 lakh is not going to give me any additional return, because it was something wrong on my part, because I was not able to judge that what was the requirement of the funds. And as I told you, that funds, they come with a cost, right? So as a result, if it is not giving me any extra return, if I've arranged, certainly out of that 10 lakh, 6 lakhs will give me a particular return and I'll be able to pay the return on that. So no issues and no worries for that matter. But when I'm talking about the remaining portion, that remaining portion means that extra 4 lakh is going to come up with an additional cost, which I might not be able to pay. And even if I'm able to pay, then at least in that case, my overall return, my income is decreasing. So ultimately, if it is decreasing my income, then again, it is an added cost. So as a result, I need to estimate my capital requirements. That means I need to estimate my capital requirement. The optimum amount that is required should be calculated, should be worked out in a very judicious manner. Then, once I have estimated my capital requirement, I need to determine the capital composition, right? In this case, when I talk about the capital composition, that means I'm talking about the capital structure that has to be decided. When I use the word capital structure, in this case, I need to take certain decisions. First of all, whether I would like to arrange the funds on short-term basis or long-term basis. Then secondly, whether I would like to go for debt component or equity. Because if I'm issuing equity, then in that case I'll have to share my ownership with you. If I'm using debt, then in that case it has a regular cost attached to it, right? So, and secondly, whenever I'm talking about the word debt equity ratio or debt equity analysis, it is not in my hand that I can take a random decision at any point of time. In this case, I'll have to decide upon the proportion of debt equity depending upon how much debt and how much equity is already prevailing in the company, right? If I've already raised a huge amount of debt, then beyond that, I cannot go for debt, even if I want to. So I'll have to see what is the present ratio of debt and equity. And based on that, then I'll decide that the additional funds have to be raised from which particular source. Then, once my debt and equity proportion has been decided, then I need to make choices like whether I would like to go for issue of shares or issue of debentures, or whether I should go for a loan from a bank or a financial institution, or I would like to go for public deposits, right? That can be maybe in the form of bonds, or there can be many other options. So the overall choice that you have to go for will depend upon the various merits and demerits of each and every source and the period of finance for which you require your funds. Once your funds have been arranged, then you have to decide how to allocate the funds. Because if you have arranged the funds, that means you had certain projects in hand. I can say certain projects, or I can say uh, you have certain ventures in which you want to make the investment. It was because of those ventures only that you have arranged the funds, right? And you have to invest the funds in those profitable ventures. See, if you are sure that the venture is not profitable, then certainly you will not be investing your funds in that, right? It is only that when I am sure that fine, this particular project is going to give me a good amount of return, then only I'll be interested in making investment in such a venture. But at the same time, I'll also see that in this venture, the overall investment will be safe and I'll be able to earn a regular return. That means I will be getting profit on this particular venture. If I can see that I will not be able to earn any profit, then certainly I will not like to go for such an investment. Now, once I have made the investment of funds in such ventures, then that means I'll be earning money on that. That will be my return. So I need to study how to dispose of that surplus. That means whatever I'm earning, how to further divide it, how to further distribute it. Now, with respect to division, there are two things. Either I need to declare the dividend. See, when I use the word dividend, that means I'm talking about the um, owners of the organization, because owners will get their dividend on the investment, right? Like if you must have heard about shares, you get dividend on those shares. So when I use the term dividend, that means on the ownership of the organization, you are getting your return in the form of dividend. And that dividend is always declared in case of equity shares. We never say that the dividend is decided. No, equity shareholders are considered as the true owners of the organization. So as a result, they have to bear the risk. That means if extra profit is there, so you'll be earning that extra profit. If loss is there, so you will be suffering, you will be bearing that loss also. So whatever is the surplus means I'm talking about the profit. So you will be declaring the dividend on that, right? So that means the rate of dividend is to be decided, and maybe other benefits, because if the company is earning sufficient amount of profits, then they would like to share it with the owners in the form of bonus, or maybe some other way, so that they can share the profits with the shareholders. Second is the retained earnings. See, whatever we are earning, we are not going to simply just distribute to the shareholders. we do distribute the dividend, or you can say we distribute the surplus among the shareholders, but at the same time we retain a particular portion of the surplus to the sorry, for the organization, so that if I have a particular portion retained in the business, I mean it will help me to expand, to diversify, to grow the business, because business also need funds for its further development, for its further growth. And every time I cannot rely upon outside funds. Every time I cannot expect that I'll be issuing new equity shares. So we need some amount on our own also, and that some amount on our own comes from the retained earnings. That means whatever we have earned, we retain it back in the business. That is known as retained earnings. So these two decisions are also to be taken by the organization. That means by the concerned financial manager, right? Next is the management of cash. See, when I talk about the financial manager in this case, he or she also has to make decisions with respect to the cash management. See, whenever I'm talking about the organization, no doubt you need to if I take the example of a hospital, certainly you require funds for setting up of your hospital, for buying the assets, right? But apart from that, you also need you also need cash for many other expenses, like for example for paying the wages, salaries to your staff, electricity bill, water bill, maybe payment to the creditors. When I use the term creditors, that means I'm talking about the suppliers from whom we have purchased the material on credit. Then maybe to for meeting the current liabilities, and the items like medicines and other consumables and all that you need to buy. So for all these things we need cash, and if we do not have the required amount of cash, then it will create a problem in the day-to-day operations. So accordingly we need to see that the required amount of cash is available. But at the same time, there has to be a financial control. That means the financial manager has not only to plan, procure, and utilize the funds, but he has to also exercise control over the finance, over the funds of the organization. That means you have to see that you keep. It should not happen that you are continuously spending the amount or the funds without keeping it into consideration that okay, there should be a limit beyond which I should not spend. So for that matter, we have various techniques, like we have ratio analysis, financial forecasting, cost, profit control, etc. Like ratio analysis, we'll be doing it further in the upcoming chapters, right? Now, if I'm talking about this financial management, let's try to study that what is the basic importance of financial management, or what is the basic? See, whenever I'm talking about the financial management, this financial management will help you in deciding the size and composition of fixed assets. When I'm saying fixed assets, that means I'm talking about, say, for example, your building, furniture, and machineries, and various other things, right? So ultimately, the size and composition of your fixed asset is going to depend upon the investment decision. That means how much capital a company is planning to invest. Based on that only, you'll be able to decide that what all kind of fixed assets you can have. Say, for example, I have a okay, I have taken a decision to invest 100 crores in fixed assets. That would result in increase in the fixed capital, because when I'm talking about buying a building, so that particular amount of 100 crores, or maybe say for example my building is going to come for maybe 10 crores, so that 10 crores is going to be invested throughout the lifetime of the business, because I am not going to withdraw that amount, and that amount is going to be invested in the business throughout. Just a minute. Right? So that means similarly, apart from building, you might be like in the hospital industry, if I talk about, there would be many such equipments, many such assets that are very much costly and that are going to be certainly be involved in the business, and you cannot withdraw money out of it. So similarly, in this case also, that will be a part of the fixed assets, or what we call as the fixed capital. Next is the amount and composition of the current assets. See, when I talk about the current assets, that means I'm talking about the bills, your inventory, all these things. They are also dependent upon the financial decisions. And in this case, it depends upon the amount of fixed assets, the credit policy of the company, inventory management, accounts, receivables management, and its activities. Because when I'm talking about the funds, these funds, they keep on investing. They keep on investing in the business, and there is a particular way in which they keep on changing their form. Say, for example, if I buy it raw material, right? Or maybe some other material. So that way, my cash gets converted into raw material. And once I buy the raw material, then it is not going to stay in the form of raw material forever, right? So that means it will keep on changing its form. So, and when it gets utilized, so it gets converted into debtors. Once you sell your or once you provide your services, then you will be getting the return from that, because the people or the customers will be providing you the bill amount, and when they provide you the bill amount, then you get your cash back. So it keeps on changing its form. So, but ultimately, the amount and composition of current assets, it keeps on varying from industry to industry, because in each and every industry you have a different form of, you can say, overall structure of the cash. Structure of the cash means because it gets involved in different current assets. Then amount of long-term and short-term funds. See, if your financial management is going to directly influence the availability of your long-term and short-term funds. The firms, they have their liquidation policy, right? So in case of your liquidation policy, some firms, they prefer to have more of long-term finance. But when I'm talking about long-term finance, the problem with that is that your profit will decrease, because in case of long-term finance, you have to pay your interest expense for a longer duration of time, right? As compared to the short-term debt. Because in case of short-term debt, you need to pay your interest only for a short duration of time, but at the same time you also need to see that what is the time period of your requirement. If you require the funds for short term, then short term is suitable. If you require the funds for long term, then long term is suitable. But still, each and every organization have their own policy, and with respect to that policy, you will see that whether you want to go for long term funds or for short term funds. Then the financial management is also going to help you to decide about the debt equity ratio. As I told you, that you can decide upon whether you want to go for debt component or the equity component for raising your funds, right? So if you want to raise your long-term finance, you can raise it through your debt sources, like you can have debentures, or maybe through equity, issue of equity shares, or it can be any other form of borrowed funds. But whatever is the decision regarding your finance, it will determine the overall amount of debt and equity in the overall structure of the funds in your organization. And the financial management will help you in deciding about the overall relationship between debt and equity in your organization. Now, when I'm talking about the financial management decisions, we say that the financial management decision will affect all the items of P&L account. When I talk about the P&L account, that means I'm talking about the profit and loss account, right? Say, for example, if my organization decides that they want to rely highly on the borrowed funds, right? So that means in that case, they will have more amount of interest to be paid. And if I have to pay more amount of interest, then certainly the overall profits available for me will be less, because whatever I'm earning out of that, a major amount is utilized to pay the interest obligation, right? Next, we move on to the objectives of financial management. See, whenever we are talking about financial management, the basic objective is to maximize shareholders' wealth. And when I'm saying shareholders' wealth, that means I'm talking about the owners of the organization. Just to maximize their wealth is the primary objective of financial management. And this concept is known as wealth maximization concept. Because in every organization, the share prices of the company, they are linked basically to the three basic financial decisions, right? The previous one that we have studied just now. And the company belongs to the shareholders only, because shareholders are considered as the owners of the organization. And the manner in which they are invested, right? And the return earned by them determines their market value and price. Because ultimately, whatever sources you, whatever funds you have invested them, and whatever return you are getting, that only decides your market prices, right? So the market price of your equity shares will increase if the benefit from any financial decision that you have taken in your organization is exceeding the cost that is involved. So that means when you are investing money, the earnings, or you can say the return that you earn on those earnings, should be more than what you have to pay in the form of cost. So if we want to list down the basic objectives of maximization of shareholders' wealth, see, right now I'm just talking about the maximization of shareholders' wealth. So that can be achieved by ensuring that at any point of time sufficient funds are available. And when I'm using the term sufficient funds, then those funds are at a reasonable cost. Secondly, when you have arranged the funds, you should see to it that there should be effective utilization of funds. Your funds should not be wasted. Thirdly, you have to see that you have safety of funds. Why? Because if your funds are not safe, then certainly you'll be earning, or you can say you'll be suffering losses. So as a result, you have to ensure safety of your funds. And when I use the term safety of funds, that means I'm talking about creating of reserves, reinvesting of profits, etc., so that you do not have to rely upon more of borrowed funds. So the overall objectives of financial management can be listed down as they are concerned with the allocation and control of financial resources, right? So to achieve this, we can have the objectives of to ensure regular and adequate supply of funds, right? At any point of time, you should have a regular supply of funds and adequate amount of funds. Because if at any point you are facing shortage, then certainly that is going to affect your working. Secondly, that there should be adequate returns to the shareholders. Because if you do not have adequate returns, then you will not be able to continue with your business. In that case, your profitability should be sufficiently high enough so that your market share price does not go down and you are able to fulfill the expectations of the shareholders. Thirdly, there should be optimum utilization of funds, because if your funds are being wasted, then certainly you are going to suffer losses. Then it should also ensure safety of investment. As I told you, that your funds should be invested in safe uh, projects, right? So that a reasonably good amount of rate of return can be achieved. Then also you should have a plan, or you can say you should have a sound capital structure. When I use the term sound capital structure, that means I'm talking about the ratio of debt and equity. Right now, moving ahead, as I told you that in case of financial management, certain decisions are to be taken, right? And these decisions are considered as the uh, financial decisions of the organization. And we have three different types of decisions in this case. That is investment decision, financing decision, and dividend decision. Now, starting with the first one, that is the financial decision. See, when I'm talking about this financing decision is also known, or you can say, you know, these financial decisions, they are categorized into three categories, and these three categories are related to investment decision, financing decision, and dividend decision. When I use the word investment decision, that means I'm talking about long term and short term decisions, because long term means I need to invest my funds for a long, or you can say into fixed assets, which are going to be involved in the business for a longer duration of time. And when I use the term working capital here, it means that this money is required for the day-to-day operations of the business. I repeat, when I'm talking about the investment decision, I require this investment decision at two levels. One is the capital budgeting and the other one is the working capital. Capital budgeting means when I need to buy the fixed assets. These fixed assets are going to be invested in my business for a longer period of time. But if I use the term working capital, then this is the capital required for running the business day-to-day operations, right? Then they also have the financing decision. Financing decision means whether you want to go for debt or equity. From that means from what all sources you will be arranging your funds, and based on your finances and your investment, whatever return you will be getting, that return has to decide the dividend decision. That means how much profit you will be distributing it in the form of dividends and how much in the form of retained earnings, right? Starting with the first one, that is the investment decision. See, when I'm talking about the investment decision, that means I'm concerned with how firms' funds are to be invested in various assets. Because until and unless you invest your funds in the assets for the organization, you will not be able to earn return on it, because you just cannot arrange the funds and keep it with you. You need to invest those funds to earn a possible return for the investors, right? So we can say this investment decision is divided into long term and short term. Long term means it is capital budgeting, and short term means it is working capital, right? See, long term, you can say it is capital budgeting, and short term, if I use, then it is known as working capital decision, right? Starting with the long term. See, long term means I'm talking about the long term assets or the fixed assets of the organization, right? So you need to invest in such assets, and these assets are going to be associated with the company for more than 1 year. So we can ultimately say that your capital budgeting decisions is they will involve your allocation of your capital, right? And that allocation is into different projects or different long-term assets which are going to be involved in the business, and they will have a long-term implication on the business. For example, purchasing a new machine, because you're not going to buy a new machine after every 2 months. So that means it will be associated with the business for a very long period of time, right? Maybe you want to buy a new building or maybe some machinery or some equipment, right? Now, the question arises, why are the investment or the capital budgeting decisions important? See, a long amount, a huge amount of uh, funds are involved in it, right? At the same time, along with the time period that is to be considered. So I can say a huge amount for a longer period of time. So as a result, it will give you, or it is of more importance. Reason being, because the size of the assets, the profitability, all are affected by the capital budgeting decisions, right? So that means it is going to ultimately affect your growth, your profitability, the risk level involved in the business, right? So whenever we are talking about capital budgeting decisions, we say that it is always for a longer duration of time, right? And when that longer duration is there, so that means we are talking about long-term growth of the organization. So all these decisions, they have a long-term implication on the business and its growth. So whatever funds are invested in long-term assets, they are likely to yield returns in future. So these will affect the future prospects of the business. Secondly, a very huge amount of funds are involved in capital budgeting decisions because they are going to be blocked for a longer duration of time. Thirdly, the risk level is high. Why? Because the time period involved is more. So once you have invested the funds, you just cannot, think of, okay, within 2 months, I'll be getting my money back. No. So as a result, the risk level is high. And at the same time, the decision taken or the amount of funds invested in your capital budgeting decisions is irreversible. That means if I've invested an amount in a particular project, I cannot expect that, if I do not find it profitable or if I do not find it interesting or if it doesn't suits me, then I can get my money back saying that, okay, I do not want to continue. So whatever funds are invested, once they are irreversible. Now, next is your short-term investment decision, or what we call as the working capital decision. So when we are using the term working capital decision, that means I'm talking about the capital required for running the day-to-day operations of the business. So whenever I'm talking about the day-to-day operations of the business, that means I'm talking about cash related management, inventory management, and receivables management. Right. So I need to decide that what should be the appropriate level of cash at any point of time. I need to decide how much inventory is to be maintained. I cannot expect that in the hospital industry, I'm going to maintain a stock of medicines for the next 1 year. No, right? Similarly, I need to decide that how much should be the appropriate amount, how much stock is to be maintained, right? So as a result, each and everything is to be taken into account. Fine. Okay, just a minute. Just a minute. Now, moving on to the next decision, that is financing decision. See, in case of financing decision, you need to see that what should be the pattern or the proportion of your debt and equity. As I told you that you cannot just, consider that you will be having only the equity funds and you will be moving ahead. Because whenever we are talking about any particular organization, any organization will not be able to move ahead with only the equity capital, because at any point of time you will need certain other funds also. So for that matter, you need to have different sources of funds, right? So you will have to see that, okay, what all sources can be there. So as a result, you will have to see that how much equity, how much debt, and if I want to issue equity, then at what time I need to issue equity, and what will be the quantum of equity, at what price. So that means a proper mix is to be taken care of, right? And whenever we are talking about the concept of debt and equity, each one of them, they come with a cost attached to it, right? So I have to study the cost associated with debt and the cost associated with equity. So whenever I'm talking about cost associated with the relevant option, then I have to see the risk associated also, because at any point of time, as I told you, that in case of equity, it will be depending upon how much profit the organization has earned, because being the owner, you will have to suffer, I mean, you'll have to get the returns in the form of extra profits, or maybe you will have to suffer the losses at times, right? But in case of debt, you do not have that option. Certainly you would have to give their respective return, because if you have taken a loan, then you do not have a choice that, okay, in this particular year, if you are not having sufficient profits, so you need not pay. In case of a loan, definitely you will have to pay the amount, right? So we consider that cost of debt is lower than cost of equity, because the interest rate is comparatively lower in case of debt as compared to the equity, because lender's risk is lower than the equity shareholder, because being the owner, I am at a greater risk as compared to the person who has given a loan, right? So as a result, we give a fixed return in the form of interest to the lender, and we give extra return in the form of additional profits to the shareholder, or you can say the owner, right? But whenever I'm talking about the interest that is to be paid on debt, is you can say is a deductible expense from the taxable income, right? So as a, or you can say it is a charge against profit. That means first you will show your interest, then after that you will be calculating your profit, which will ultimately decrease your taxable income, and this taxable income will further calculate your tax liability, right? But if I talk about being the owner of the organization, whatever is the amount of dividend that you will be paying me, that will be my return for the investment that I have made. There is no fixed rule for that, right? So that means in that case, I'll charge more. So ultimately, we can say debt is cheaper, but is more risky for the business, because a fixed interest rate is to be given on that, right? Whereas if I talk about the equity side, in equity we say it is costly but less risk, because ultimately I am the one who's going to bear that risk, right? So as a result, the organization has to maintain a mix between the two, that is debt and equity. Now once it has been done and taken care of, then you need to decide upon your dividend decision. And with respect to dividend decision, that means you have to see, or you have to study the disposal of profits, because whenever I'm talking about dividend decision, it is related to how much profit will be distributed as profit to the shareholders or to the owners, and how much will be retained in the business, right? So ultimately here in this case, the role of financial management is to decide how much is to be retained in the business and how much should be distributed. That distribution that you provide to your shareholders is known as dividend decision. Fine. So with this, we come to the end of your chapter 1, or you can say first topic. Right. Now we move ahead with the second topic, that is financial statement analysis. Right? When I'm talking about financial statement analysis, let's first study what do we understand by financial statements. See, financial statements means I'm talking about you can say a formal record of the financial activities of any organization, right? So you can say it is a kind of reports that is going to quantify the financial strength, the financial performance, the financial liquidity of the organizations. So it is going to reflect the financial effects of business transactions and the events of the overall organization over a given period of time. So whenever we are talking about such things, in this financial statements, we have four major components. And these four major components, they will basically present the financial information of the organization in question as clearly as possible. So that means you will get a gist, or you can say a conclusion of the overall transaction of the entire year. I'm not saying that it is going to provide you each and every transaction related to the entire year, but yes, it will provide, it will provide you information in a nutshell, right? So these financial statements, they usually include the income statement from which you calculate your profit and loss account, your balance sheet, from which you will come to know your financial position of the business, your statement of retained earnings, that means how much was the total earning and how much was retained in the business, or what all was done with respect to your earnings, and your cash flows. That means one statement which will provide you information related to inflows and outflows of cash, right? Now, whenever we are talking about these financial statements, do remember that these financial statements are publicly available. Each and every company, they have to get their accounts published. That means their accounts are these financial statement. I'll not use the word uh, their accounts, but their financial statements are available on their websites. Even if you talk about their annual report, it is available over there, right? But if I want to talk about any XYZ company, I can get their details from the concerned company's website. So anyone can have access to it. So as a result, these financial statements are often audited by government agencies, accountants, firms, etc., so that even the organizations can ensure that accuracy is there, and even for tax purpose, there is no ambiguity, and even for financing and investing purposes. Because as a lender, if you want to invest in my company, you would like to know about the financials of my company, and those financials can be known through these statements. And if in case you want to invest in my company, you want to know the financials, that means if you want to buy the shares of my company, then you can get the information about my company from these statements again, right? Now, starting with the different financial statements, we use the term financial statement, or we can say it is a financial report. As I told you, it is a formal record. Why do we say formal record? Because you have to, especially in case of companies, you have to follow the Companies Act 2013, because now the act that is into consideration is Companies Act 2013. And all these statements, they will give you information about the financial activities and financial position of the business, of the concerned business in question, right? So whenever we are talking about such statements, we have different types of statements. Like you have the balance sheet, income statement, statement of changes in equity and equity statement, or you can use the term statement of retained earnings. Then you have a cash flow statement and a funds flow statement. See, no matter, I have written here a funds flow statement has given in your syllabus, but do remember that funds flow statement is not published. So I highlighted this, right? So you can just write it here that this is the portion which is not published by the organizations. Rest, all others have to be published by the organizations and they are freely available. And secondly, when we talk about this funds flow statement is not prepared by every organization, no matter it is a planning tool, but it is an, you can say it is an internal document or an internal statement which some organizations prepare and which some organizations do not prepare, but rest all others are definitely prepared by all the organizations, right? So if I start with the individual, that is balance sheet. Balance sheet is also known by the name of position statement, right? This is a statement which will provide the financial position of the business, right? That means the assets and liabilities. And when I talk about liabilities, that means liabilities and owner's equity. Second is your income statement, which is also known as statement of comprehensive income or statement of profit and loss, which will give you the information regarding the expenses, losses, incomes and gains of the organization over a period of time. And at the end, whether the organization is earning profit or suffering loss, that is also given in this. Next is a statement of changes in equity, that is going to give you the details regarding the changes in the equity over the given time period. That means if the company has raised more capital, then from what all sources they have raised the capital. Then if in case you have more, you can say retained earnings, that means whatever you have earned during the year, whether you have distributed it in the form of dividend or you have retained it in the business, all those details will be shown in this statement. And you have the cash flow statement. See, cash flow statement and funds flow statement are same to some extent. The only difference is when I'm talking about funds flow statement, that is a broader concept and cash flow statement is a narrow concept. Because in case of funds flow statement, I'm talking about the overall funds of the organization. Whereas in case of cash flow statement, I'm just talking about the one component of the overall funds, that is cash. So here in case of cash flow statement, we are studying the inflows and outflows of cash for a given business over a period of time. And in case of funds flow statement, I'm studying the sources and application of funds, or you can say it is again the same thing, that is inflows and outflows of funds. But here the concept is broader because we are considering the overall funds of the organization. Now moving ahead with the detailed discussion regarding the individual financial statements, starting with the P&L account. See, when I talk about the P&L account, as I told you, it is also known by the name of income statement, right? This is a summary of all the business transactions over a period of time. When I say that I'm preparing the P&L account, that P&L account is prepared at the end of the year. And when I prepare it at the end of the year, this is this will tell me the overall profit of the organization for that particular time period, right? So in this case, my basic objective is to know whether the organization has earned profit or have suffered losses. So what all things that you will be presenting over here are income, that means customer sales, or maybe if suppose you have sold some asset, so whether you have earned profit on that or you have suffered a loss. If it is a profit, then we show it as an income. Then maybe some non-operating incomes, like some investment is there, and no matter that investment is not the core activity of the business, but still you earn some sort of income on that, so that is shown as income. Then you have expenses, both the direct as well as the indirect expenses are to be shown over here, right? Then now you can just have a look that these are the, or you can say this is the format how we present our trading and profit and loss account. See, this is the trading and profit and loss account for sole proprietorships and partnerships. You can just you can say these are nothing but for right. So these are not for the companies, right? So because in case of companies, the format is a bit different. Fine. So these are the this is the format. You can see the overall profit and loss account is divided into two categories. One is the first part is known as the trading account, and the second part is known as the P&L account. And they are not prepared separately. They are prepared in this manner only, one after the other in the same account, right? So in this case, what happens is that you have to just see all the direct expenses. They are shown over here. See, do remember all expenses on this side, all incomes on this side. Why? Because all expenses are to be debited, right? So on the debit side, and all incomes are to be credited, and so they are to be shown over here. Debit means left hand side, credit means right hand side, right? So as a result, all the expenses are shown here. The first part will show all the direct expenses. This side will show all the direct revenues. Then you do the total of both the sides. When you do the when you do the total, you calculate the balancing figure. If your this side is less as compared to this side, so it is considered that your direct expenses are less as compared to your direct revenue. So that means you have earned profit. Certainly, if my expenses are less as compared to my revenue, then only I'll be earning profit. So that balancing figure is known by the name of gross profit, and that gross profit, it is transferred to the capital to the P&L account, right? So when I have to transfer it to the P&L account, so you can see that this is transferred here, right? Now if I say that my this side is less as compared to this side, so that means that my expenses are more as compared to my revenue, so that will return into losses. And if I suffer that loss is to be transferred here on the, see, whenever we are transferring it, it is the opposite side, right? So as a result, I have shown it here. Now if I talk about these expenses, these revenues, see, sales is my direct revenue, right? So as a result, I have shown it here, as I told you, sales. Now, whenever I'm talking about sales, many a times what happens is that there are certain items which were not maybe ordered by me, or which were not as per my specifications, or maybe which were defective. So whatever may be the reason, I will return them. And if I return them, then in that case, that will decrease the amount of net sales. So I show it as less returns. So this is sales minus returns. The net figure will be shown over here. And when I say closing stock, see, whatever I have purchased in the current year, not necessarily that will be used in the current year. At the end of the year, there might be certain units which are still left unused or unsold. So in that case, I'm not going to, throw away all these things. I'm going to utilize these in the upcoming year. When I'm going to utilize these in the utilize these things in the upcoming year, then in that case, they are shown as closing stock, right? So this closing stock that will be used in the next year, that will also be shown on the revenue side. Next is, if I move ahead with the expense side. See, like in the current year, I have closing stock. Similarly, in the previous year also, I must have had some closing stock. And that closing stock of the previous year becomes the opening stock of the current year, right? And when I talk about the current year opening stock, that current year profit, or sorry, that current year stock is going to be used in the current year, right? The current year closing stock, which becomes the opening stock of the current year, that is going to be used in the current year. So we consider it as an expense, like we consider the purchases. So opening stock plus purchases minus returns. As I told you, like in case of sales, I can have returns. Similarly, in case of returns also, sorry, in case of purchases also, I might have returns, right? So in that case, I'll show the net figure over here, that is net purchases, right? After that, I can have direct expenses. Now, when I'm talking about the direct expenses, that means I'm talking about the expenses which are directly related to the production floor. Like in the hospital industry, that means I'm talking about the expenses related to the you can say hospital. I'm not talking about the administrative department. I'm not talking about the billing department, right? But I'm talking about those expenses, like if you are, admitting a patient. So what all expenses you are incurring on that patient, right? So they are a part of your direct expenses. That means the people who are employed over there, if you have to pay wages and wages to them, right? Whatever are your expenses, they will be a part of your direct expenses. Then we do the total. This line means it is the end of your trading account, right? Then we move ahead with the P&L account. P&L, this second portion is the P&L account, right? So in this case, once we have transferred the gross profit or gross loss, then all the indirect expenses on this side and indirect incomes on this side, right? So that means here I'm talking about maybe your billing department, maybe your you can say front desk executives, or maybe your administrative department. So all those people, if you are paying them salaries, certainly you would be paying them salaries. So salaries will be shown here. If suppose your building is on rent, or maybe you have taken some building on rent, then the rent will also be your indirect expense. Then maybe your commission or any such thing, your advertisement, whatever discount you have given to your patients, the depreciation that you charge on your fixed assets, all these things will be counted as your indirect expenses. That means which is not related directly to your you can say production floor, right? Now on the right hand side, you have your indirect incomes and gains. So when we are talking about indirect incomes and gains, in this case, if I have received a discount, so that is my gain. Sorry, yeah. If as if I have received a discount, that is my gain. So I'll show it on this side. But I have given a discount, so that is my loss. So I can say it is discount allowed. So on the debit side. So again, we do the total of both the sides. And when we do the total of both the sides, we calculate the balancing figure. Once we calculate the balancing figure, if your this side, debit side is less as compared to your credit side, then that means it is a case of net profit. And that net profit goes to the owner of the organization. That means in case of sole proprietorship, it will be the sole proprietor, and in case of partnership, it will be the partners. So it is transferred to their capital accounts. If it is a case of net loss, then it is again to be transferred to the capital account of the owners. This is the format of a P&L account in case of companies. But do remember that in case of companies, we do not call it as P&L account, we call it as statement of P&L, right? So in case of companies, we follow the Companies Act 2013, and Companies Act 2013 says that there is no P&L account. It is the statement of P&L that you are supposed to prepare. So that means it is the same thing, but the presentation is different. So you can see the format of preparation is different. So in this case, we have this first column for numbering. Even if this column is not there, then it is fine. But starting from particulars, in which you will be showing the main headings. Then you have note number. Then you have figures at the end of the current reporting period and figures at the end of the previous reporting period. That means in this case, you show simultaneously figures of 2 consecutive years. You are preparing it for the current year, so you show your current year first, followed by the previous year, right? And in case of this previous year, these figures are just given so that you can make an immediate comparison if you want, right? So in this case, we start with revenue from operation. See, in case of companies, we follow the Companies Act. So the terms used are also the same as given in the Companies Act, right? So we use the term revenue from operation. And when I use the term revenue from operation, that means this revenue from operation is nothing but your net sales, right? Because in case of sole proprietorship, I was using the term sales and less returns was net sales. But in case of companies, we do not use the term net sales. We use the term revenue from operation, right? So this is the portion we are talking about given in the trading account in case of trading and P&L account. Then we have other income. Other income means I'm talking about all those items which were shown in your P&L account in the form of indirect incomes and gains. So that will be shown as other income. Then we do the total of the revenue side. Then we have expenses side. Among the expenses, I have cost of material consumed. When I talk about cost of material consumed, that means I'm talking about this, right? That is opening stock plus purchases plus return plus direct expenses and minus the closing stock. So that means I'm talking about the cost of those materials that have been consumed during the year, right? Then I need to consider the purchases of stock in trade. See, many a times what happens, some of the organizations, they are not into manufacturing. They are just into the trading. So that means for them, there is no material consumed. It is only the purchase that you have to do, and that is known as purchase of stock in trade. Then you have to consider the changes in inventory of finished goods, work in progress, and stock in trade again, depending upon if your organization is a manufacturing concern or it is a trading concern. Then you have employee benefit expenses. Employee benefit expenses basically means all those expenses that you have incurred on employees, maybe in the form of salaries, or you can say bonus, or maybe some incentive that will be a part of your employee benefit expenses. Then you have finance cost. When we use the term finance cost, that means we are talking about the cost that you have to pay on the finances that you have arranged, like your interest that you have to pay on the loans. Then you have depreciation and amortization that is to be applied on your fixed assets and your intangible assets, and there can be any other category of expenses. So you do the total of all the expenses, and then total revenue minus your total expenses will give you profit, right? From that profit, you need to subtract your tax related details, and then you calculate your overall net profit. Now, the basic question arises, what is the major advantages of this profit and loss account? See, when I'm talking about the advantages of your profit and loss account, do remember that it is going to track your net profit and net loss. Otherwise, just with the transactions during the year, you will not be able to understand that how much profit or loss has been suffered by the organization. So if in case you want to know the exact amount of profit earned or loss suffered, then it is the P&L account only that is going to serve your purpose. Secondly, it tracks your indirect expenses. See, you will not get a detail of your indirect expenses until and unless you prepare your P&L account. And these indirect expenses are to be specially taken care of. See, direct expenses, so you know that you cannot restrict, but indirect expenses should not cross a particular limit, right? So you have to keep an eye on it, that you know how much you are spending on advertisement, how much you are spending on the incentives, how much you are spending on providing the sales promotional techniques. So there can be many other things. So because many a times these indirect expenses, they go unnoticed. So we have to keep a track on them. Then it also helps in ascertaining the net profit ratios. because these ratios will help you analyze the present situation of the organization. So all the ratios related to your net profit can be calculated only with the help of your P&L account data. Lastly, it also helps in decision making, because whatever profit or loss you have calculated, that data will help you in analyzing what the present situation is, and based on that, how to plan for the upcoming future, right? And when you plan for the upcoming future, then it will give you an idea that, okay, this decision is to be taken, and accordingly things will move ahead. But whenever we are talking about the advantages, do remember that it's not that this is completely without any disadvantages, right? So whenever we are talking about the advantages, it has certain disadvantages also. Like, you can say that it is not a complete picture. Now, when I use the term, it is not a complete picture, that means your financial decisions are not only based on the data given in the profit and loss account, right? So to understand other things related to the business, you also need to understand its financial position, and that financial position is depicted by your balance sheet, not just by your profit and loss account. Secondly, it will not give you an insight into the cash generated. See, what all items you are presenting in your P&L account, they are not going to depict any cash inflows and outflows, right? And whenever I'm talking about this inflows and outflows, it is very important, because until and unless I know the inflows and outflows, how will I manage my cash? So your P&L account is not serving that purpose. And as a result, if you want to manage your cash, then you need to prepare a cash flow statement. Then thirdly, if I talk about the period of reporting of your P&L account, see, period of account, you can say accounting period is historical. That means the year which has passed, I'm calculating the profit for that, right? So at times it becomes late for the stakeholders for taking any decision, right? So, and they do not want to take any incorrect decision, but yes, based on the information provided, because that information is related to the year that has already passed. So as a result, they might end up taking incorrect decisions. Next, we move ahead with the balance sheet. As I told you, balance sheet is your position statement, which tells you that on any specific day. See, when I'm preparing the P&L account, I say it is for the year, for the entire year. But when I'm talking about the balance sheet is on a specific date. So that means it is telling me the information related to the financial position of the business. And when I use the term financial position, that means I'm talking about the assets and liabilities of the business on a particular date, that is on which we are preparing the balance sheet. So I can simply say it is a snapshot of the financial status of the organization, right? But do remember, it is valid only for the day for which I am preparing it. And this balance sheet is going to give me the information regarding the resources and obligations of the business. Obligations means I'm talking about outside people and the owners as well, because even owners are providing the capital. So at the end, they also need their money back, right? So that means we can say it will provide me information about the assets, liabilities, and shareholders' equity. You have two options of preparing the balance sheet. That means you can prepare it in an account form, and you can prepare it in a report form. And you have different ways of presenting the balance sheet. That means liquidity order and permanence or permanency order. When I use the term liquidity order, liquidity basically means how quickly you can convert a particular thing into cash, right? So if I talk about the different assets and different liabilities, the asset which is more readily convertible into cash, or that means which I can convert into cash immediately, that will be written first, followed by the second, and further followed by those which will take more time to be converted into cash. Similar way we follow for the liabilities also. And if I talk about the permanency order is exactly the opposite of the liquidity order. That means the thing which is more permanent will be written first, followed by the things which are not so permanent. Now, as we have talked about the different things that we have to present in the balance sheet, the first is the assets. Assets means the resources owned by the business. So do remember to, concentrate on this word. When I'm using the word owned, that means which belongs to the organization. Something which has been taken on rent is not owned by the organization. Right now, the question arises when I'm talking about an asset. What all things can be counted as an asset? See, anything which follows three criteria, that can be counted as an asset. Now, what is that criteria? The first should be that particular resource which you are talking about should be valuable. That means it should have a value attached to it. It is not free, right? Secondly, the organization should own it in legal sense. That means it is in my name. I cannot say just because I am carrying it, it belongs to me. No. If I've taken a house on rent, so that means it is in my possession, but that is not mine. Thirdly, the resource must be acquired at a cost. That means it should not be free, as I told you, right? So whenever we are talking about these assets are divided into three categories: fixed assets or long-term assets, current assets, and investment. Starting with the fixed assets, that means I'm talking about those assets which are acquired for a long-term duration. That means which will be associated with the business for more than one accounting period, right? And they will help the business to increase its profit generating capacity. They will help the business in earning future profits, right? Now, when we are talking about these fixed assets are further bifurcated into tangible and intangible assets. Now, as the name suggests, tangible assets means I'm talking about those assets which have a physical presence, right? Say, for example, I'm talking about land or building, or maybe plant, machinery, furniture, something like that. So these assets are always shown at the cost in the balance sheet of the firm. So when I'm using the term cost, we show it as cost minus the depreciation. So the net value will be shown, right? But we always consider the cost. We do not consider the saleable value, or we do not consider the market value. Next is your intangible assets. That means the assets which do not have a physical presence and they reflect the rights of the company, right? For example, your patents, your copyrights, trademarks, goodwill, etc. And these intangible assets, they are written off over a period of time, because if I do not write them off, so that means they're going to continue and be shown at the same price throughout the lifetime of the company, right? So as a result, and that will not serve my purpose. So in that case, it is always suggested that if suppose I have got the copyright, say for the next 5 years, so within those 5 years, I should write them off. That means at the end of 5 years, the value will reach zero. So that if fresh copyrights are to be purchased or are to be applied for, so the fresh valuation will be done. Then the next category of assets is current assets. Current assets are opposite to your fixed assets and they are short term in nature. Fixed assets are long term and these are short term. So we can say that these are those assets which are held either in the form of cash or they are expected to be realized in cash within the given accounting period or the operating cycle of the business. So the various forms of current assets could be cash, marketable securities, accounts receivable, inventory. That means we are talking about stock. When I use the term inventory, it is nothing but your stock. Because as per the company act, we do not use the word stock now. We use the term inventory. And there can be another category, that is investments, right? When we use the term investments, that means whatever extra money we have, the idle funds, we want to invest that, right? So we can say these investments can be long term or short term. And depending upon the time period for which you have invested, these investments will be categorized as long-term or short-term assets, right? Next, we move on to the other side of the balance sheet, that is liabilities. Liabilities means, that means we are talking about the claims of outsiders against the firm. Because see, many a times, we have taken something on credit, or maybe we have taken a loan. So based on that, the people who have given us the credit, or the people who have given us the loan, they have a claim on the company. So as a result, we can say that these liabilities will represent the amount that the firm owes to outsiders. See, in case of assets, we had the term own, right? But in case of liabilities, it is owes, right? So that this particular word will help you in understanding and remembering the concept. Right, and depending upon the time period for which the liability is there in the business, we categorize it into long-term liabilities and short-term liabilities. Starting with the long-term liabilities, that means the funds or the liabilities which are for more than one accounting period, they are termed as long-term liabilities. You can take the examples in the form of debentures, bonds, maybe other mortgage loans, secured loans from financial institutions, or maybe from the banks and all. And do remember that these liabilities are to be repaid after a certain time period, depending upon for how much time you have taken this liability. But at the same time, you have certain short-term liabilities also, which are known by the name of current liabilities. And these current liabilities are again payable to outsiders, but they are for short-term period. That means they are usually paid within the accounting period or within the operating cycle of the firm. Like we have accounts payable, bills payable, tax payable, trade credit, right? So these are the different forms of, or maybe outstanding expenses. When I talk about outstanding expenses, that means I'm talking about the expenses which have become due, but we haven't made the payment. Say for example, that salaries for the month has become due. The January has passed and your salary becomes due, but the organization has not paid the salary. So that becomes an outstanding expense for the organization. The third component of your balance sheet is owner's equity, or what we call it as the capital, and it represents the residual claim of the owners on the assets of the company, right? Because if I am the owner of the organization, it doesn't mean that, I do not have any sort of claim just because I'm the owner. Even I do have a claim on the assets of the company, and that is to be assessed after settling all the external liabilities at the end when the company is to be winded up. Owner's capital is not withdrawn during the lifetime of the company. Owner will be paid his or her capital only if the company, if the organization is to be winded up. And and if I talk about the sole proprietorship or partnership, in case of sole proprietorship, the owner is known by the name of owner, or you can say sole proprietor. In case of partnership, they are known by the name of partners. And in case of company, they are known by the name of shareholders, right? And we have two types of shareholders in case of your companies, that is equity and preference shareholders, in which equity shareholders are considered to be the true owners of the organization. Now, this is the balance sheet format for sole proprietorships and partnerships. I'll mention it here so that it becomes more clear to you. That is for sole proprietorship and partnership, right? Because they can prepare, they are not for companies, right? They can prepare this balance sheet in this T form, or what we call it as an account form. This side, left hand side is the liability side and right hand side is the asset side. So you have mentioned all the assets on this side, liabilities on this side. And if you remember that when I started with the topic, I told you that in case of balance sheet, we can have two methods, that is liquidity order or permanence order. So you can see liquidity order means things which are more convertible into cash. So I've started with cash in hand. And in case of liability side, it is the bank overdraft that is to be paid first, because the time period for bank overdraft is less as compared to other liabilities. And if you have any other liability which is to be paid before your bank overdraft, then that is to be mentioned first. So this is how you will be presenting your balance sheet. And if you want to prepare the balance sheet as per the permanence order, then the reverse of this, that means if I write all these things in the reverse manner, then that will be your permanence manner. Similarly, we can have format for the balance sheet as per Companies Act 2013, which is given in Part 1, Schedule 3 of the Companies Act 2013. This format is to be followed by the companies, and in case of companies, you cannot follow the previous format. You have to follow this only. Again, in this case, you have a column for particulars, note number, then current year figures followed by the previous year figures. As I told you that the previous year figures are given simultaneously so that you can make an immediate comparison. Again, in this case, we use the terms that are given by the Companies Act. We do not simply write it as liabilities, we write it as equity and liabilities. And you can't even change the sequence of the items given, because Companies Act is very, very rigid with respect to the items that you have to show, with respect to the terms that you use and the sequence that you follow. Right, so all the liabilities, then you do the total of all the liabilities, then you list down all the assets, and then you do the total of all the assets. The only thing is that terms used are different, but otherwise it is the same thing. Now the question arises, what is the basic significance of preparing the balance sheet? See, first of all, do remember that this balance sheet will help you to study the financial health of the company. That means financially how strong the company is, right? So the stakeholders will be able to understand the liquidity position and the performance of the business from this balance sheet. Then also by comparing the balance sheet over the years, it will help you in determining the growth of the company. That means over the years, whether the financial position is improving, growing, or it is deteriorating. Then it is also essential if in case the business requires a loan, because any bank or any financial institution which is going to provide you loan, that will like to go through your balance sheet, that will like to study your financial position, because they want to know whether you have the repaying capacity or not, whether and secondly, they want to know what is your previous track record with respect to the previous loans, and how much loan already you have raised, what all loans are going on. So all these things will be taken or will be considered before giving you the new loan, and all these things will be given in your balance sheet. Then it also helps in analyzing the ability of the organization to undertake expansion of projects and any unforeseen expenses. So ultimately, how strong or how you can say financially efficient you are, right? And also it will help you in identifying the source of companies funding. Say for example, whether you have more of equity or you have more of debt or you have a combination, and if you have a combination, then what is the ratio between the two, because the ratio is also to be studied. There might be a possibility that I have equity and I have debt. The ratio is there, but I have already raised so much debt that a further debt will increase my interest paying interest payment, and I will not be in a position to repay that. So in that case, the lenders will not lend me further money. At the same time, there are certain limitations of the balance sheet. First of all, as I told you, for the P&L account also, it is prepared on a historical basis. That means whatever year has passed. So even in case of balance sheet, I am preparing this balance sheet on an historical cost basis. So in this case, whatever assets you are recording them on the prices on which they were purchased. Rather, those prices are no more valid in the present day situation, because in the present day situation, the market price of those assets have changed. So that means you are not giving a you can say updated picture. Secondly, window dressing may be done in balance sheet. When I use the term window dressing, that means I'm talking about the manipulations. Many a times certain manipulations can be done in your balance sheets to present a better view of your books of accounts, to show a better financial position of your books of accounts. So as a result, this will again create a problem, right? Then there can be if I'm talking about the historical cost that is presented in your balance sheet, it will not convey you a fruitful information. Because if I'm saying that, my building is at 10 lakh rupees, right? So that means that was the purchase price less the depreciation. So in my books, it is shown as 10 lakh, but might be that the present value of that building is 1 crores in the market. So that is not going to give me an exact picture, and it will be not fruitful for me to judge the exact situation of the business. So, and when we are talking about the different assets that you record in your business, these different assets, they are valued according to different rules. And when you are talking about different rules, so that means different strategy for different assets. So as a result, I cannot, stick to one strategy. I cannot stick to one rule based on which I can analyze the situation given in the balance sheet. The third statement that we prepare is your cash flow statement, right? So when I'm talking about this cash flow statement, this cash flow statement is also known as the statement of cash flows, right? And when I use the term cash flow statement, that means I'm talking about inflows and outflows of cash, right? So whenever we are talking about the inflows and outflows of cash, it is, I mean, we want to study this inflows and outflows of cash, because until and unless I know the details related to it, I will not be able to manage my cash. And if I have to study the cash, if I want to know that what exactly is the situation related to cash, then I have to prepare my cash flow statement, which will study the inflows and outflows of cash and cash equivalents. No doubt we'll be doing this cash flow statement in detail in the upcoming chapters, right? So as a result, even the significance and limitations I haven't covered over here. Next is your funds flow statement. As I told you, fund flow statement is similar to your cash flow statement, with the difference that funds flow statement is a broader concept, right? Why? Because here we are considering the overall funds of the organization, whereas in cash flow, we are just considering one component of the funds, that is cash. So cash flow is a narrow concept, and that is used for short-term planning, whereas funds flow is a broader concept, and that is used for long-term planning. But yes, as per Companies Act, funds flow is not mandatory, but cash flow is mandatory. So the organizations definitely they prepare their cash flow, but many organizations they do not prepare their funds flow. So that becomes optional. That is a planning, you can say, tool. And in this case, we are studying the sources and application of funds, right? So as a result, then next is your statement of retained earnings, right? See, whenever I'm talking about the statement of retained earnings, we say it is a statement uh, in the form of a financial document which will show the earnings of a company that has been accumulated and kept in the business since its inception. As I told you, I'm talking about profits retained in business for expansion purpose, right? So these numbers, they are going to provide you an insight into the company's financial position and the attitude of the owner towards reinvestment related to growing their business. See, because uh, if I have a good amount of retained earnings, what does it mean? That means I have sufficiently high amount of profits and I'm able to satisfy my shareholders as well as my business requirements. So as a result, in this case, and secondly, in this case, even the shareholders are having an attitude of, okay, they have an acceptance that if the organization is investing back the money, or you can say they are reinvesting the money back into the business, so they are okay with it. Because ultimately in the long run, if you see that in the short run, okay, I can say, you are using my money to reinvest it in your business, so I am getting less amount of returns. But you should try to understand the broader concept, because in the long run, if you see that this reinvestment is going to increase the overall profits of the organization. So when you get the overall profits of the organization, so that is going to help me, because overall growth will result in more amount of profits, and more amount of profits means more amount of dividend that as an owner I will be getting, right? So it is the attitude of the investors, or you can say the owners, that has to be studied over here, whether they are okay with it or not. But yes, if you are having retained earnings, if you are investing the amount, then certainly they have an attitude of acceptance, right? So with this, we come to the end of today's